it's May, and in May, when an economist gets up to talk, you've got to talk about the budget. Now, I think budgets are fascinating documents. They're absolutely riveting for about 3 days. But after that time, if you don't know everything you want to know, then you're just not interested anyway. But I do have to cover it off to some extent before we get to the more important matters, namely what the hell's going on in Europe. Just on the budget, as you know, the government the government's commitment, if you like, was, and it almost regarded this as its test of economic manhood, was we are going to show you how we are going to get the budget back to surplus next year, despite the fact that we're starting from a deficit of $44 billion. We knew they were going to make that the test, and we knew that they would produce a budget that would do that because they did it last year and they did it the year before, and they made a commitment to do it. I actually think this is not good economics to plan on a surplus next year. In fact, you could argue it's bad economics. Just to understand that, all you've got to do is go back 6 months to the so-called mid-year economic and fiscal outlook, when 6 months ago the government budgeted for a small surplus in 2012-13, but 6 months later, the current budget, they actually had to do a bit more repair work, raise a bit more revenue, move a bit more spending around, cancel some foreign aid projects. They had to do a bit more repair work to come up with the same surplus that they forecast 6 months earlier. Now, why did they have to do that repair work? And the single answer is because the Australian economy in recent months has been weaker than we thought it was going to be, so it hasn't been generating as much revenue. So our response to a weaker economy is to tighten fiscal policy further to get the surplus. This is exactly what you should not be doing in weak time. If the economy is softer than you thought, if anything, you should be loosening fiscal policy, not tightening it. So it is, as I said, it's bordering on bad economics. And it certainly isn't nearly as important as the government told us that it was. The night before the budget, I was on a show on Sky Business. It's called The State of the Nation. It's an hour long, and there's a big panel. There was me and 11 distinguished speakers, and so there's 12 in total, obviously. So you're going to have to fight for oxygen, particularly since David Murray was on the panel and used up most of it himself. But and what he didn't use up, John Hewson did. The moderator thought that he would introduce all 12 of us by going around very quickly and asking each and every one of us the same first question. And that question was, what is the one thing you most want to hear from Wayne Swan tomorrow night in his budget speech? And I was the lucky last person to answer this question. So all the good answers had been taken, and I must say, I know this is an old story, but I felt a lot like Elizabeth Taylor's last husband. You know, it's obvious what I had to do. It wasn't clear how to make it fresh and different. Every single one of the 12 of us, well, not one of the 12 of us said, I want to see how Wayne's going to get back to that surplus. Instead, the things we heard, the words that came out most often were confidence, productivity, and infrastructure. And there was a bit too much of getting back to surplus and not enough about those things in the budget. Having said that, while it's clearly not as good as the government thinks, it's not as bad as the opposition thinks. Anyway, just a few quick slides that relate to the budget. First of all, the economic forecast you can't really quibble with. It's a bit of a rosy scenario, but they're entitled to do that. There's no real quibble with this. Here is what they're planning to do. Here is the deficit as a share of GDP going to surplus. And you may not be able to spot it when you look at it this way, but suppose you take the first difference of this chart. Here is the fiscal contraction, if you like, that we're planning next year, the change in the deficit as a share of GDP, and just briefly, it's at least twice and maybe 3 times as big as anything we've ever accomplished before. Now, it's true a lot of this is smoke and mirrors. Move spending into this year, move revenue back into next year, but that's not a quick criticism, that's actually a feature, because the less of this is genuine tightening, actually the better for the Australian economy. And just to put this, you know, there's obviously a lot of countries around the world in a worse fiscal position than we are, but I just want to show you our planned fiscal consolidation against the planned fiscal consolidation in all the other OECD nations. And there's us over on the far left. Briefly, there are only 3 countries, Cyprus, Greece, and New Zealand, who are planning to reduce their deficit faster than we are. And I'm not sure that's company we want to be in. And just one last point about the budget, whenever you hear a shock jock or an opposition politician banging on about Australia's public debt and how we're adding to it at $120 million a day, and that's absolutely shocking. Please stop listening. Australia does not have a federal debt problem, never has, and probably never will. There's our debt to GDP ratio this year and 4 more forecast years, and just a few other countries to compare us with. Now, none of these are paragons of virtue, I will grant you, but it's ridiculous to say Australia's ever had a public debt problem. Now, on to the more serious issue, of course, first thing we look at every day, what the heck's going on in Europe? Obviously, Greece is the centre there, and just briefly, I mean, you all know this, they've had one round of elections, there's another one coming up on the 17th of June. They have a system of proportional representation in Greece, and what that means is you'll get a coalition government of some kind, and the real choices are, I guess, is do you get a centre-right coalition or a left-leaning coalition? The centre-right coalition is quite happy to go along with the current austerity/debt repayment programs. The left coalition, if that were to be elected, and that's obviously an if at this stage, do not want to pull Greece out of the euro. But they do want to renegotiate the austerity programs with the Troika, the ECB, the European Commission, and the IMF, and the debt repayment schedule. If Greece falls out of the euro, it falls out by accident, and it falls out because at some stage the new Greek left-leaning government, if elected, gets into a deadlock with the Troika. The Troika basically suspend the flow of bailout money to Greece. This precipitates a run on the Greek banking system. The new government basically puts capital controls in place to stop money leaving the country, and the day that happens, they've left the euro. Because the day that happens, a euro inside Greece is no longer the same as a euro outside Greece, and they're done. Let's put it this way. If Greece were to leave the euro and that were the only thing that were to happen, life would go on. This is a small place. The Greek economy is smaller than the economy of the city of Philadelphia. So Greece isn't really the risk. The risk is, of course, that there's a significant contagion effect somewhere else, and particularly these days the crosshairs seem to be on Spain. If you get a run on the Spanish banking system, then there will be serious financial consequences around the world. So that's the risk. And I don't think anybody can predict what happens when this does happen. Now, the odd thing about this is that, Greece escaped from the Ottoman Empire, if you like, 180 years ago. In that 180 years, it's been in default or restructuring after a default for about half the time. So this is not uncommon, but of course they weren't a member of a common currency union then, and so the interconnectedness certainly was not there, and I guess that's the main issue on this occasion, plus the fact that the financial sector is now so much more important in the overall running of the global economy. Now, of course, if Greece does leave, their new currency, which presumably will be a drachma, will plummet early on. We know that. So I'm not licensed to give financial advice, but if I were you, I'd be booking a Greek holiday as soon as you can. It's going to be very cheap for a while. There might be a bit of civil unrest, but that's it's actually entertainment. Greece is also in trouble if they stay in the euro because they are massively uncompetitive. And they can't ever regain that competitiveness. They either regain that competitiveness by devaluing their own currency, leaving the euro, or else it's going to take them years of austerity anyway. So this really is a no way out situation. Now, just some of this. On the left, you've got the difference between the long-term bond rate in the countries I think of as the ones that were traditionally in trouble, Greece and Ireland and Portugal. On the right, the same thing for the bigger countries. If you go from the differential with the German bond rate to the absolute level here, here's what's happened for the two countries that really matter here, Italy and Spain. They're in the first round of concern about Europe. We heard about this on the video late last year. As you can see, I think of this as a trouble index. When your long-term bond rate goes up, if financial markets decide you, a country, have a debt problem, then they'll still hold your debt, but they'll bid up your long-term interest rate. And if you subsequently have to issue debt or refinance old debt, then your interest costs go up, which adds to your debt. So if you begin with a debt problem, the first thing that happens is you get a bigger debt problem. And there's no, arithmetical exactitude about this, but the lines in the sand that financial markets seem to have drawn is 6% when, above 6% you're in trouble, above 7% you're in deep trouble. And you can see Italy was in deep trouble last year. Some of that was alleviated by the ECB's LTRO program, which basically flooded money indirectly into the European bond market. That did drive down yields, as you can see, but they have been creeping back up. Just to bring this chart completely up to date, the Spanish bond rate today, the bad news is at 6.08%. The good news is 24 hours ago it was 6.28%. So these are the countries you need to watch. Greece per se really doesn't matter. I should mention that I take my responsibility for sessions such as this very seriously indeed. So much so that, that is for talking for you and the other audiences to whom I speak. I take my responsibilities seriously. So much so that on your behalf last year, my wife and I undertook a month-long study of the Greek and Italian debt crises. And I can tell you this, if the Eurozone is in recession, it is not my wife's fault. But importantly, and I think this is an important point to make, nobody, certainly among the conventional forecasters, thinks this is anywhere near GFC2. No, the global economic growth forecasts are still holding up quite well. That is what this shows you. Every number here is a forecast for GDP, or economic output growth, for this calendar year. The first column shows you what the consensus forecast was for growth in these various economies in August of last year, and the last column the same thing in May. And incidentally, for those of you eagle-eyed, I did get the last UK number wrong. That should be 0.4, not 0.7. But importantly, in the second half of last year, the European situation was deteriorating fast enough that global economic growth forecasts were cut by a full percentage point, but they haven't changed so far this year. And that last forecast was dated around the 11th of May, so there may be some wobbling in the month or two ahead, but if the world grows at 2.6%, that is not great growth, but it is a long way away from global economic recession. You'll see that in fact growth prospects in Germany have in fact picked up in recent months. And you never hear about this side of it. Greece is being basically, is massively uncompetitive inside the euro, but Germany is massively competitive. So they're running a current account surplus of about 5% of GDP, while Greece is running a deficit of around 10. Just my view on financial markets, and I stress that, my view only. When I put this together, at the start of this series, our currency was 101. It's 97.5 today. That's the first time ever I've been, certainly in the last 2 years, where the currency's actually dipped below my forecast, because I've been trying to get the Australian dollar down for some time. Essentially because it's been levitating, and fair value, by my estimate, is in the high 80s these days. It has to come down, had to come down at some stage, but I always tell audiences that, but I also tell them we're not very good at this, and they shouldn't believe anybody's forecasts. The official cash rate, this is interesting. As you know, we got a double cut from the Reserve Bank in early May. They essentially wanted the variable mortgage rate to catch up with where they thought it should be. The financial markets have priced in 4 more rate cuts. I think you get 4 more rate cuts if and only if the European situation is pretty dire, and if and only if the recent improvement that we saw in 3 indicators for the Australian economy, retail trade, building approvals, and the labour market, in the space of 1 week, if that improvement is evanescent and just goes away again, then you get 4 rate cuts. I actually think the Reserve Bank might hope that it's done, but obviously the bias is still downwards, and so I've got 1 more rate cut in there. And neither Wimmel nor Wimmel doesn't agree with that bond forecast, and Crispin probably thinks the equity market forecast is too high either, also, but they're not their forecast, they're mine. Now, just very briefly on the currency, the red line here is the Australian dollar in US cents, and US dollars, I'm sorry. And the other line on the chart, the yellow line, is what they call a trade-weighted index of the US dollar. So that measures the US dollar against the currencies of all of the developed world that the US trades with. Now, you'll see for the first 8 years of this chart, the 2 lines move together. And that led me to start to think, well, the yellow line's the right answer, it's fair value. And that's why I think the Australian dollar has to come down eventually. Now, incidentally, I spotted this pattern around late 2007. You know, that the Australian dollar seems to tend to come back to the yellow line. And I thought, I've got an edge here. I can use this in forecasting. So I started to use that as my forecasting rule. The red line will come back to the yellow line. And the day I started to use it, it stopped working. This is actually a common phenomenon in forecasting. You know, you think you found a relationship between A and B, you use A to forecast B and it stops working. It's got a technical name, it's called premature extrapolation. And a friend of mine suffers from it quite badly from time to time, but he thinks he's found a partial cure. You keep on forecasting, but while you're forecasting, you think about something else. You know, it's been above fair value for 2 years. And so maybe this chart's not working, but what else are we told? The Australian dollar's held up by commodity prices. Yeah, but they've come off. It's held up by interest rate differentials. Yeah, but we've narrowed them. I actually find this chart quite interesting. The red line here is the Australian dollar. The yellow line is actually a share market index for Asian emerging markets. And incidentally, if it were fully up to date, that yellow line would be down to the next horizontal line drawn across there, because Asian markets have been clobbered in this episode also. Why would you ever put a currency up against a share market? And the answer is they're both plays on global economic growth. And you know, from about mid-2008 to somewhere in early 2011, this is phenomenal. You know, it's like a hand in a glove. But since that time, as you can see, share markets dropped away. The Australian dollar held up. I think finally it might be reacting. You might see if you come back from your far right to the second dip there, that actually represents a period from September 10th to October 4th last year, when the currency fell from $1.08 to 94 cents in 3.5 weeks. And that's the sort of thing that can happen. Now, ex post, there's a clear reason why it did happen then. That's the period of time when my wife and I were in Europe. And if it will help you at all, we're going offshore again in August. Late August. Just a few other things about the Australian economy. Here's the labour market. Incidentally, everything you've heard about the two speeds is absolutely correct. But employment in total, after being flat for most of last year, has shown a bit more life this year. The unemployment rate, and remember this covers both the strong and the weak sectors, the unemployment rate 4.9, it has only been lower than it is right now in 5 of the past 35 years. If however you go to the composition of employment and just look at who gained in jobs, and these are in thousands, not in percent, who gained in jobs in the year to February and who lost, there's almost as many, well, there's more sectors that lost than gained, and it's exactly what you would think. Mining's up there in second place, and down near the bottom, you've got job losses in construction, in mining, in manufacturing, in retail trade, and in accommodation and food services, a lot of which is tourism. And that, of course, is all, in my view, more a consequence of the high exchange rate than high interest rates. And we should be getting some relief on the exchange rate. Now, I'm almost out of time. Just very quickly on inflation, this is always important for the Reserve Bank, but it's not important now. And it's not important now because it's under control. The best measure here is underlying inflation, and essentially it's underlying inflation in Australia. Despite all the popular views that inflation's quite high, underlying inflation is the lowest it's been in 13 years. And headline inflation, as you can see, is actually too low in the sense that it's below 2, but that's mainly because bananas are cheaper than they were a year ago. And you don't want your monetary policy decision driven by the price of bananas. Now, I'm very close to running out of time here, so I think I'll just... This shows you the mining boom, mining investment boom, and tries to make it as dramatic as I can. The other 5 components are investment in 5 other industries. And my summary slide looks like this, and I'll just put it up and you can read it. And then I'll hand you back to Marty. Thank you very much for your time. Have a great day.